Hi, my name is Darren, and this is HCJ.tax, and we're a team that seeks to demystify that sometimes confusing world of international tax. And today we again have the honor and privilege of having a conversation with the one and the only Mark Morris. Mark, can you please introduce yourself?
Yes, I'm an expert in automatic exchange of information and exchange on demand, and I've been consulting for the OECD and the EU Commission and the EU Parliament since the days of the EU Savings Tax Directive in 2002. And I've done nothing else for 25 years but focus on exchange of information. And I give seminars and websites, etc.
Okay. The next question is again, following on, now that we understand the definition, now that we understand the purpose, the objectives of the crypto asset reporting framework, what exactly is the difference between, because we have like three frameworks for information exchange. As you said, we have FATCA, the original one. Then we have CRS, otherwise just known as the automatic exchange of information. Now we have CARF. How is each different from the other?
So CARF reports on relevant transactions rather than income and asset value for reportable crypto asset users. The reason why they went after transactions is many people just buy a crypto and never use it, and they'll never be picked up. Maybe those people that bought Bitcoin a decade ago and haven't sold it, they're not going to be picked up now until they do a transaction. Okay, we'll go over the transactions just now. Now, what is different is the reporting party in automatic exchange that was known as the financial institution, but the reporting party, the reporting crypto asset service provider, can be any entity or individual. This is a big surprise that they're going after individuals as well, that effect a relevant transaction. That's the main important word, affecting transaction. They don't define what affecting is, but experts have analyzed it and says affecting means you make it happen. Okay. Reports on crypto don't report on the asset itself until there's a transaction. So this is in effect waiting for a submarine to surface before attacking them. The major difference between CRS and CARF is due to the infamous shell bank loophole in FATCA and CRS, identified by the US Senate Finance Committee. This is where professionally managed investment entities, simply they're a financial institution, and they're different from other financial institutions because they're the client themselves, simply having an entity that earns income, most of its income from assets. They just don't report on themselves. Well, they do report, but they lie. They just go to the portal and report. There are no reporting users, no reportable users. So that's a big lie. So unless that's audited, and it's very seldom that it's audited, why did you report that there's no reportable person? I think it's easy. If somebody reports no reportable persons for both FATCA and CRS, the jurisdiction where that financial institution is should go in and do an audit. Why, you're a financial institution, why did you report no reportable persons for FATCA and CRS? That's too suspicious. But the OECD knew that this was a major loophole. The US Senate Finance Committee in 2021 gave some suggestions on how to tackle it. Really, it's through the GIN. When you register for a global intermediary identification number, they want to be more stricter, but they've done nothing since then. So OECD said, okay, if there's a non-participating, they went after all investment entities. All investment entities are treated as passive NFEs, and I'll look through. So there's no more, I'm going to set up my own investment entity, professionally managed. They won't report to me. Every single investment entity is now transparent and look through to the controlling persons. But funny enough, that investment entity remains a financial institution. So it's still got reporting obligations. So there could be duplicate reporting, one by the shell bank or the investment entity, and one by the underlying crypto asset service provider looking through to the controlling persons. So to me, that's the biggest difference. And it closes the major loophole of CRS and FATCA.
Okay, fantastic. Thank you very much for that. So, Mark, if anyone wants to reach you and contact you to find out more about these tax planning and structures, what's the best way to do so?
Well, it's easy to just Google Mark Morris CRS or Mark Morris Automatic Exchange, but my website is www.co-ownershiptrust.com. The co-owner has got a dash, a hyphen.
Okay, thank you very much for that.
But it's easy to find me just Googling me, Mark Morris OECD, Mark Morris. I've got articles on The Economist, and it's easy to find me.
Fantastic. Thank you.